$3.4 billion. That's how much superyacht sales volume moved in a single quarter of 2023. Not purchases, not leases, transactions. And the people writing those checks weren't buying vacations. They were restructuring balance sheets. Here's what nobody explains. A superyacht isn't a luxury, it's a holding structure, and once you understand how the asset actually works, the whole thing stops looking like excess and starts looking like a playbook. A superyacht, legally and operationally, is a commercial vessel. The moment it enters a charter program, it becomes a business. It generates revenue. It qualifies for depreciation. It sits inside a corporate entity, usually offshore, usually in the Marshall Islands or Cayman structure, and that entity files taxes, carries liabilities, and interacts with port authorities as a commercial operator. The owner doesn't own the boat. The owner owns shares in the company that owns the boat. That distinction is everything. In the U.S., if a yacht is flagged correctly and placed in active charter, it can qualify under IRS guidelines as a business asset. That means accelerated depreciation. A $50 million vessel depreciated over 5 years strips $10 million per year off taxable income. For someone in the top bracket, that's a $3.7 million annual tax reduction per year on an asset they're using. The charter revenue offsets operational costs, crew, fuel, maintenance, port fees. Those costs average $1 to $1.5 million annually per $10 million of vessel value. If the charter income covers 30 to 40% of that, the net carry drops dramatically. The asset is partially self-funding. Cyprus, Cayman Islands, Panama, Marshall Islands. These aren't just registration bureaucracies, they're legal regimes with specific implications for VAT, import duty, crew taxation, and liability exposure. A yacht flagged in a VAT-exempt zone and operated in international waters owes nothing on the purchase. Bring that same yacht into EU territorial waters without proper paperwork, and the exposure is 20% of vessel value. One $80 million yacht, one documentation error, $16 million in retroactive tax liability. The owners who navigate this correctly aren't lucky. They have Maritime Tax Council running jurisdictional planning before the vessel is even built. Superyachts hold value better than aircraft and worse than real estate. The depreciation curve front-loads the loss, then flattens. A vessel bought at $40 million, depreciated to $25 million on paper over 5 years, can transact at $32 million in a secondary sale. The owner has claimed the full depreciation benefit, then recovered equity on exit. The taxable gain is calculated from the depreciated basis, not the original cost. That's the engine. Buy, depreciate, charter, sell, repeat at larger scale. The secondary market is where the financial logic fully closes. COVID restructured global supply chains for yacht construction. Lead times for new builds pushed to 5 and 6 years. Existing vessels, already sea trial certified, already crewed, already documented, traded at premiums. Owners who entered pre-2020 and exited 2021 to 2023 captured appreciation on an asset they'd been depreciating for years. It's not a coincidence that the people doing this at scale are the same people who ran tax-advantaged real estate before bonus depreciation rules changed. The playbook migrated. The asset class changed. The structure didn't. When you see a superyacht in a harbor, you're not looking at consumption. You're looking at a registered commercial vessel inside a non-domicile corporate structure, actively depreciating, partially charter-funded, VAT exempt on acquisition, and positioned for a basis-advantaged exit. The wealthy don't buy things. They build structures. The yacht is just the most visible one, because the real luxury isn't the vessel. It's owning something most people think is frivolous, while the IRS treats it as a depreciating business asset. The ocean doesn't care what it costs. Neither does the tax code, if you know how to read it.